You want money, you don't want to work hard for it. I mean, who wouldn't, right? You have a few mates boasting about making big on crypto and their penny stock investments, and now you have all this FOMO and you want to get in as well. So how does it actually work? Unfortunately, investing in stocks is not the get-rich-quick strategy that many people might think it is. People love sharing all about their wins and boasting all over the internet. But for every one of those people, there's a lot more who've lost a heap and don't want to think about it because they're embarrassed and just don't want to talk about it. For example, me losing all the money that I put into cryptocurrencies. Hey everyone, I'm Shane and I'm a 4th year finance student at the University of Sydney, and I'll be sharing all the financial theory and concepts that you need to know about investing before you put a single dollar of your hard-earned money into the stock markets. The first financial concept is the whole underlying principle behind investing, and that is the time value of money. Would you rather have $1,000 today or $1,000 10 years down the line? This is because you have a lot more freedom of what you want to do with the $10,000 today. You can save it for later, you can use it now. You have a lot more options available. This is why investing works. By putting your money into an investment, you are essentially sacrificing the opportunity of having that money today. And then because of the time value of money, you need to be fairly compensated with more money in the future when you do decide to withdraw your investments. And the most common form of compensation for this is interest. So we all know that if we put our money with a bank, they will pay us interest for us putting our money with them as a reward. And if it was the other way around, if we borrowed money from the bank, we are taking an advance payment of that money and they're sacrificing their money, so we would have to pay interest to compensate them. And similarly for governments, they would use bonds where they borrow money from us and pay us back in terms of bonds with repayment structures and all that complicated stuff. But basically, depending on how long you borrow or how long you lend money, that amount changes based on the interest rate, which is what is determined to compensate you. And for example, if you have a yearly interest rate of 3%, then for each year you put your money with the bank, they will pay you 3% of your initial deposit. So if you put in $1,000, they will give you $30 each year. But again, with interest, there's nothing really special about them. These are all pretty much risk-free. Like if you're putting your money with a bank, there's not much chance that bank will go bankrupt and you'll just lose everything. And if you're borrowing money from the bank, for example, for a mortgage, then they won't have much risk because they know if you don't end up paying them, they can just sell your house. So that's why interest is very, very stable. And these rates are also fixed. So they will say in advance, we'll pay you 3% in interest each year. That's not going to change. Even if there's a good year financially or like a bad recession, that amount will be the same. So that is essentially the time value of money and all about interest. Now we'll talk about the next concept, which is all about risk. And this explains why you generally make more from stock investments than you do with savings and interest rate accounts. So I'll give you another hypothetical example. Would you rather have $1 guaranteed given to you today? Or would you rather have a 50% chance of getting $10,000 and a 50% chance of losing $9,998? Both of these expected returns are exactly the same. If you do 50% times 10,000 minus 50% times 9,998, that is also equivalent to 1, except there's the risk component because you don't know which one you'll end up with in the second option. So to compensate investors for taking on some of this risk with some types of investments, like for example stocks, they need to be fairly compensated for it. And this is why with investing, you are compensated not only for the time value of your money, but also for whatever amount of risk you decide to take on. For example, with credit cards, banks might think you have a bad credit history, and they might charge you a higher interest rate. And this is also the case with mortgages, where they might not give you the best interest out there. If you're a young person, you might not have that credit history, and the bank isn't certain, as they would be with someone older, in thinking that you'd be able to pay them back. So there's an element of risk involved for the bank because they might lose everything if you do end up defaulting and going bankrupt. So they will charge you the high interest rate to demand extra return for it. And this is the same with government bonds. For safe countries like Australia and the US, where the governments are very, very reliable in paying back their bonds, they have a AAA credit rating, and it means their interest rates that they offer you are not that great. But for other countries where there's a lot of risk in the government not being able to pay you back, like Greece a few years ago when they were in a huge amount of debt, their interest rates that they offered with their government bonds were very, very high in order to compensate you for the risk you took on in them not being able to pay you back. Now with stocks, there's another uncertainty to be introduced, and that is volatility in the markets and volatility in the company you're investing in. So first, essentially a stock is a piece of ownership of a company. So for example, with Amazon, we might not know if Amazon's going to go really, really high up, or they might crash if a new competitor comes in, or they lose a CEO or something like that. And also macro events such as coronavirus, which will impact pretty much every company out there and affect them negatively by making them lose sales and lose customers because of lockdowns and all the stuff like that. Then that's another thing that can cause stock markets to go up, down, and introduces something called volatility. So therefore we know there's a lot of uncertainty in how well stocks and particular companies are going to perform. And as a result of that uncertainty, there's risk in what their stock prices are going to be. And therefore you can generally expect higher returns on average because they will compensate you for that amount of risk. The mathematical term for this is volatility and represents the standard deviation of all possible returns. A risky stock, which means high volatility, is expected to move up and down quite a large percentage, but a more safer stock is not expected to move around into prices as much. Therefore, for stocks with higher risk and higher volatility, investors need to be compensated more for the risk that they are taking on, compared to, for example, safer stocks and interest rates, government bonds like that. So basically, as we can see from this graph, as your risk increases, so too does the expected return that investors need to be fairly compensated for. And as we can see on the point where the risk is zero, that is essentially known as the risk-free rate, and is the percentage return or the interest that investors need to be compensated for just purely for the time value of money and not for any risk that they're taking on because it is risk-free. The third and final concept is diversification, and that explains pretty much the best strategy of how to actually invest in the stock markets. Diversification pretty much means not focusing on just one particular stock, but choosing a wide variety. And even though these stocks individually might be very risky, combined together, it reduces the risk significantly. This is because for individual companies, there is a lot of natural risk involved, like when they have a bad year because of their particular industry not doing well. For example, airlines in 2020, or there might be like an internal event where they lose a big CEO or a big member of their C-suite executive team. So that risk, which is exclusive to that one particular company, can be reduced by diversification. And that is essentially buying lots of different stocks from lots of different companies from all these different industries. And that means even if one stock might not be doing too great, it's not significantly impacting your whole investment because that is only, for example, maybe 1%, and the another 99 companies that you have invested in are doing fine. So because this risk can be easily diversified away, investors are not compensated for this. And they are only compensated for what is known as market risk or systemic risk, and that is risk that affects the whole stock market as a whole. So as an example for something that affects the whole market, that can be something like coronavirus, which impacts every single industry out there because it's so widespread and not specific to a single company or industry. So this is known as market risk, and because this risk cannot be diversified away through buying lots of different stocks because everything will be affected, investors need to be fairly compensated for it. Basically, this is known as the index market portfolio and can be represented, for example, by an index such as the ASX 200 or the S&P 500, which is just a basket of all these different stocks put together in different weights and ratios and combined into one investment portfolio. And these can be constructed by companies such as Vanguard, which make ETFs, and these can be traded by retail investors who want to be exposed to this market portfolio and be compensated for the market risk that they're taking on. And as we can see here, the market risk is greater than the risk-free rate, obviously, but it's a lot less than these certain individual companies. However, the expected return is not much less, and that is because the individual companies are not being compensated for their idiosyncratic or their individual company risk, whereas the market portfolio is being compensated for that market risk. And we can construct a portfolio anywhere along this line. This is known as the capital market line and has every optimal investment combination out there. For example, you can choose to invest purely in the risk-free rate and not take on any risk at all. Or you can invest purely in the stock markets at the market portfolio, which is represented through an ETF, and you are compensated with a high expected return, but you do take on some of that risk, and you could lose a percentage of your investment. However, you can go halfway in between. You can put 50% of your money in the risk-free rate and 50% into the market portfolio, in which case you would be compensated with the expected return halfway in between. Or what you can do, which is not recommended, is borrow money at the risk-free rate and invest double the amount into the market portfolio, in which case you'll have a much higher expected return, but your risk is also a lot higher. So basically for my portfolio, I have about half my money in the risk-free rate, which is in savings accounts, and I have the other half in different ETFs. For example, I have some in the ASX 200, I have some in the NASDAQ, and some in the Asia Tech as well. By having these different ETFs, it also helps me to diversify a bit. And I've entered into the market at different times to not expose myself to sudden dips in the market and spread out my investment at different periods of time. I'm not saying this is the best investment portfolio and that you should replicate it as well, but it's what makes sense to me and seems the most logical and rational investment strategy, based on my own risk tolerance and also what stage I am at in my life and how much capital I actually have. There's not really a minimum amount of money you need to have before you start getting into investing, but generally you just want to make sure that you're not paying more in fees that is greater than 1% of your investment portfolio. Like if you're investing $100 and you're paying $20 in fees, you've already lost 20% of your investment portfolio, and that is quite a sizable chunk. Again, this is just my own individual investment portfolio based on the theories and concepts in finance. Hopefully you've gained a better understanding of stocks and the concepts behind investing and why it actually works. So I'm considering doing more videos, one on a step-to-step guide on how to actually put your money in and buy stocks yourself, and also other making money tips in general. So let me know if that's something you guys want to see down in the comments below. If you guys enjoyed this video, then make sure to give it a big like down below and also subscribe to this channel to not miss out on my future content where I share studying tips and tricks, tech, money, and uni life. As always, take care and I hope to see you guys in the next video.